Life is rough. Thursday used to be the new weekend, but like everybody be there, but then nobody be in classes on Friday. Now it's like, we're just taking Friday or Thursday off. You guys can take a minute, just kind of go through these questions. I'll give you 4 or 5 minutes. It's not a quiz, it's just practice to see how you learn during reading. This chapter is very confusing. It's worse than 15, but I'm going to hopefully try to distill it down for you so that it's not that hard. Okay, let's go ahead and walk through these. Taxable income of a corporation differs from accounting income due to differences in intra-period allocation between the two methods of income determination. I'm not really sure what that means. Differs from the accounting income because companies use the full accrual method for financial reporting, right? That's GAAP. but use the modified cash basis for tax reporting, which is what the tax code is. So the answer here is B. The modified cash basis is basically saying, for the most part, we're going to use cash basis, but there are a couple things that they do accruals on. And makers is a modified depreciation allowance. And it's not really, it doesn't really have much to do with cash, that part of it. But there are differences between the depreciation rates, which causes temporary differences. Recognizing a valuation allowance for a deferred tax asset requires the company consider all positive and negative information in determining the need for a valuation allowance. Consider only the positive information in determining the need for an allowance. Right, that doesn't sound right. Why would we need an allowance if it was positive? Take an aggressive approach in its tax planning. No. Pass a recognition threshold after assuming it will be audited by tax authorities. So this one is A. Major distinction between temporary and permanent differences is permanent differences are not representative of acceptable accounting practice. Permanent differences are part of the practice. Temporary differences occur frequently, whereas permanent differences occur only once. That's not true. Once an item is determined to be a temporary difference, it maintains that status. However, a permanent difference can change in status with the passage of time. Not with the passage of time. It would have to be pretty much something coming from Congress, likely, for that one to be. And then D, temporary differences reverse themselves in subsequent periods, whereas permanent differences do not reverse. So that is the answer. Stewart's Corporation taxable income differed from its accounting income computed this past year. An item that would create a permanent difference in accounting and taxable incomes from Stewart would be using the balance in the unearned rent account at year end. No. That wouldn't be a permanent difference, right? That'd be a temporary difference. Using accelerated depreciation for tax purposes and straight line depreciation for book purposes. That'll create a deferred tax asset, or excuse me, deferred tax liability. So that one's a temporary difference. A fine resulting from violations of the OSHA regulations. And that is the answer there. The IRS does not allow you to deduct fines or penalties. Now, that being said, that is a general rule. Sometimes you'll see corporations who make huge mistakes, like the BP, when they leaked all the oil in the Gulf. Was that 10 years ago now, 20 years ago? They negotiated a way that they could deduct part of it. That means we pick up part of the bill. So when the government has fines and penalties, we really want them to stick with those fines and penalties and make them non-deductible. But in general, fines and violations are not tax deductible. Recognition of tax benefits in the loss year due to loss carry forward requires, and this would be the establishment of a deferred tax asset. We're going to jump down to pre-tax financial income. And this can be referred to as a number in a number of ways. We call it income before taxes, income for financial reporting purposes, or income for book purpose. I don't know why we have so many different things and they're not consistently used over everybody's financial statements, but it all means the same thing. It's just, what is your income before you assess your tax rate on your financial statements. Taxable income, the amount used to compute income taxes payable based on the Internal Revenue Code. A temporary difference is the difference between tax basis of an asset or liability and its reported reported carrying or book value. And GAAP-based financial statements. I got them right there. These differences will result in taxable amounts or deductible amounts in future years. And so a taxable amount increases taxable income in the future years. We'll later call these deferred tax liabilities. Gracias. It actually opened up to the right page. A deductible amount decreases taxable income in future years. Deferred tax asset. So there's this little chart that I like, and it says revenues or gains, expenses or losses. Reported on the income statement now, but on the tax return later. And this would be reported on the tax return now, but the income statement later. And so what are some of these? So you have something like installment sales. And unrealized gains from fair market value recording of investments. Rent collected in advance would be something you have to report in the tax return, but we wouldn't report it as revenue. It would be unearned revenue in the financial statements. Subscriptions, collected, etc. Estimated expenses and losses. So this would be like a warranty estimate or a bad debts estimate. You have to do them for the financial statement purposes in the period, but you cannot claim them for tax purposes until the future. Unrealized loss from fair market value recording of investments. Accelerated depreciation in tax return in excess of straight line and prepaid expenses. So these are kind of some examples that are in the category and cause temporary differences. Take your time. Okay, now I also want to show you here, if you go to the back few pages, I put in the key income tax terms. Now these all are still terms that you have, but they come from all the tax terms that I could remember, so they may be more than the keywords listed in your book. And when I say remember, that doesn't mean I can actually remember any of them. All right, this is also from your textbook, illustration 18-20, and these are a bunch more examples. I couldn't like take a picture of it and post it in here for some reason, so I just copy and pasted it in here. And so this will be helpful when you're doing the exam or homework, because you've got your key terms and then you've also got what are my temporary and permanent differences. Now we're up to permanent difference. A difference between taxable income and pre-tax financial income that only affects one but not the other. So what does that mean? These mean that they can either be recorded in revenue for GAAP, but not tax, or they can be recorded in revenue for tax and not GAAP, or the expenses can be okay for GAAP and not okay for tax, or vice versa. So basically, these differences set forth typically by Congress because of the tax things that they want to motivate with taxes. But your financial reporting doesn't follow all of these. All right, and so permanent differences result from items that either enter into pre-tax financial income, but never taxable income, or enter into taxable income, but never into pre-tax financial income. Okay, so this talks about some of the things that Congress has enacted for certain political, economic, and social objectives. Like they want you to be able to buy bonds and at the same, or municipal bonds to support their cities and towns and potentially states, but they don't want them to have to pay high interest. And so one way they do it is they tax deduct the interest. So for income tax purposes, if you buy bonds for localities in the United States, then you don't end up paying taxes on the interest that you receive from those bonds. Now, that's only at the federal level, right? We're talking about IRS. We're not talking about state taxes. State taxes, anything goes, really depending on the state. So I don't want to jump into that, I guess, challenging arena. Okay. And again, if you're looking for, what are some examples, those are all listed on the last page. Those are the ones that the book says. So this one's recorded for financial reporting purposes. These would be recorded for tax purposes. Income tax has two components. One is sort of your current income tax. And this is the amount of income tax payable for the period. And deferred tax expense is the change in deferred tax assets and liabilities from the beginning of the period until the end. So an example entry to record tax expense would be a debit to income tax expense. And this would be your pre-tax financial income times your tax rate. You would debit deferred tax asset, if applicable. You would credit deferred tax liability, if applicable. And you would credit income taxes payable. And this is the income tax. I want to make sure I said that right. Give me 1 second. Taxable income, sorry. Times the tax rate. Let's look at example 1. Okay, so the book basis should be fairly easy to figure out, right? It says that we use straight line and it has a 5-year useful life and a salvage value of 150,000. So we take the 18, 1,800,000, we subtract 150,000, and then we divide it by 5. $60,000 a year? No, that can't be right. Yeah, 60,000 per year. Did I do that right? I don't think I did that right. Give me 1 second. No, that's 330,000 is better. Okay. Sorry about that. So for book, we have our cost, and that equals 1,800,000 minus accumulated depreciation, which would be 330,000 at year end on 25. And so that would be 1,470,000 for the book basis. We know it's either going to be B or C. Now for tax purposes, they use the double declining balance method. And so you have 1.8 million times 0.2 right? This is 0.2 equals 1 out of 5 years, right? And then it's double declining balance, so we're going to multiply that by 2. And so when we multiply that out, I believe we get 720,000. Yeah. So that would have been the depreciation for tax purposes. So basis equals the 1.8 million cost minus the tax depreciation, which is the 720,000, and that equals 1,080,000 basis. So our answer is C. So in simple terms, all this is saying is that we deducted more depreciation for tax purposes, and as a result, we're going to owe this difference in the future. So when we think about a deferred tax liability, we would take the 1.47 million And we would subtract the 1,080,000. And get 390,000. And then we'd have to multiply that by the tax rate to get the deferred tax liability. If anybody wants this stuff explained, they can just ask Yadi or Valerie. They did taxes for personal individuals on Vita, right? Did you guys see any of this? No. Strictly for business, so I'm just teasing. All right, so what is a deferred tax liability? It's the consequences attributable to taxable temporary differences. In plain English, which I'm not sure I know anymore, a deferred tax liability represents an increase in taxes payable in the future. And those are due to temporary tax differences. Let's take a look at example number 2, give you about 30 seconds to read it, and then I'll go through it. Okay, so it says the corporation purchased a machine on January 2nd, 2024 for $4 million. The machine has an estimated 5-year life with no salvage value. So just a quick compute yearly depreciation for income for financial statement purposes. And so we have 4 million minus 0 divided by 5. And so I think that's 800,000. Yeah. Okay, so now it's asking us, assuming the income tax rate of 20% for all years, the net deferred tax liability reported on the balance sheet as of December 31st, 2025 is. And what we have to do is look and say, okay, in 2024, we took book depreciation of 800,000. Tax depreciation was 800,000. Now in 2025, tax depreciation equals 1,280,000. And we subtract the book depreciation, which is 800,000. And so we get, I think that's 480,000, which we have to multiply by the tax rate. So that's 0.2. And we multiply that out and we get 96,000. Any questions there? Okay. Jump to example number 3. So we want to find the deferred tax asset to be recognized. And so we have to look for temporary differences. That result in future deductible expenses. And so the estimated litigation expense of $3 million will be deductible in 2026 when it's expected to be paid. So in our financial statements, we put in an estimated litigation loss or expense for $3 million, and we can record it in that year because that's when it was incurred. But the IRS says, listen, until you pay it, you can't deduct it. And so it's expected to be paid in the next year. So what we have is our taxable income will be $3 million higher than our income statement income. And so we have to multiply the difference by the tax rate. So we have 3 million times 0.20 tax rate, and that equals 600,000. So the question is it current or non-current? And the answer is all deferred tax assets and liabilities should be listed as non-current. Even if you have some portion of them that is due in this next year upcoming, which when we have debt, right? We have a current portion of long-term debt, and then we have a non-current portion. For deferred taxes, it's all listed as non-current. So the answer there would be D. All right, let's see if I remember how to correct that. I don't know. Did it work? Let's go to the all-powerful Google. So sometimes when I copy things in with Word, if I copy them from somewhere else that has like a French or a whatever, it'll actually come into the document. So it's a pain. Right. This is group work, by the way. I'll give you all points. So a deferred tax asset is the deferred tax consequence attributable to deductible temporary differences. In English, it's the increase in taxes refundable or saved in future years. And this is due to temporary or deductible temporary differences. Try this, Carter. Under review, click on language and then set proofing language. Get it? Yeah. All right. Just took away all your extra points. All right. Now let's take a look at example 4. It's long, so we're going to take a nice walk through it. I'll go through it. So for part A, we take our pre-tax financial income and that's 125,000, right? That's given here. Then we have temporary difference resulting in future deductible amounts. In 2026 and 2027. So in 2026, and cause 40,000 and 70,000. And so your taxable income equals 235,000. And so this is our taxable income. Income taxes payable equals your taxable times the tax rate. And so we have 235,000 times 0.3. And that equals 70,500. Any questions there? Okay, good. So part B now asks, prepare the journal entry to record income tax expense, deferred income taxes, and income taxes payable. And so we have a future deductible amount, so deferred tax asset equals the future deductible amount multiplied by the tax rate. And so here, pay attention if the rate changes. So for this one question, we can take the 40,000 plus the 70,000 and get 110,000 for the future deductible amount, because tax rate is 30% for all years. So now we take the 110,000 and we multiply it by 0.3. And so our deferred tax asset equals 33,000. So remember back to our entry, we had income tax expense. And right now we don't know what that is. And so we would go, what are our pieces? We have a deferred tax asset, which we calculated at 33,000. And we calculated income tax payable at 70,500. And so the difference will be our income tax expense, 37,500. Now I want to show you something because it's kind of annoying to me because we know the income tax expense. What we do is we take the pre-tax financial income and we multiply it by the tax rate so we can check to see that that plug matches our income tax expense. Any questions? So I'm going to let you go a little bit early today. I got a student who is leaving, and with the weekend coming, we'll just pick up with the next example that is very similar to this one. Oh, you know what? I didn't finish C, so let me do C first before I throw you guys out of here. Part C, prepare the income tax expense section of the income statement, beginning with the line income before income taxes. So income before income taxes. And that's 125,000, right? That's our pre-tax financial income. We said that's the same. And then you have income tax expense. And we're not going to put the total in here now because it's a kind of two-step process. So we have current, 70,500, and deferred, 33,000. And so our net we said was 37,500. And that gives us net income. We take the 125, subtract out the 37,500, and we get 87,500. So, hello. Okay, it's working good. All right, so we'll pick up with another example, 5 in the next class on Tuesday. Have a good weekend. Try not to think about taxes too much. And I'll see you then.
We're doing personal tax, accounting